Hello, welcome to today's webinar in our series on year-end tax saving strategies. We've had a few other webinars recently here focusing on Roth conversions and solo 401ks. In today's webinar, we're going to be talking about deadlines and contribution limits for your IRA and a few other accounts as well as we go through today's webinar. For those of you who are listening live to the webinar, if you have any questions during the webinar, please type those into the chat box or the question box, I should say, on your screen. We'll make sure we get those questions answered for you as to the best of our ability as we go forward. So if you're listening to this though on the recorded version, jot down your questions. My contact information is here on this slide as well. You can email me, call me with any questions you have about anything that we cover during today's webinar, maybe something that pops up in your mind that I don't touch on. So again, if you're listening live, please type those questions into the question box and we'll get those answered as we go through it. My name is Scott Maurer. I'm the Director of Business Development for Advanta IRA. Been with the company for a number of years, seen a lot of different things, have helped out in the company in regards to helping people make alternative investments inside their account, answer questions on reporting, contributions. I've taught a lot of classes to realtors, CPAs, and attorneys as well. So today is really just a continuation of what I've been doing for many years. I am a licensed attorney as well in the state of Florida, although I do not practice law for any Advanta clients. It's something I'm not permitted to do, just with a conflict of interest. So, but certainly gives me maybe a better understanding of things that we'll talk about when it comes to self-directed IRA accounts. Just a quick disclaimer, anytime we do a presentation, whether it's an online webinar, whether it's a live class maybe in one of our offices in Tampa or Atlanta, we don't provide legal, tax, or investment advice. We also do not endorse any products, and we're not affiliated with any other companies, even including companies or individuals who may appear as a guest presenter or a guest lecturer. We bring those other individuals and companies on to help share some knowledge and some education. But we do not necessarily endorse what they are selling or what they do per se. It's more from an educational perspective that we provide this information. We certainly can refer individuals to attorneys, accountants, tax advisors, and other financial advisors if you need more information. Now, some of the things we'll talk about today and even in our classes, we do delve into some legal and tax issues, but we can't give advice in that range. So if we're giving out a fact, that's one thing, and that's fine. But when it comes into somebody wanting advice, should I convert my IRA to a Roth IRA, or should I make this particular transaction? That's where we do defer and can refer you to other individuals and other professionals. Just a quick background on our company for anyone who is unfamiliar with Advanta IRA. We are over 15 years in the industry. We have over $1 billion in assets under management across almost 7,000 clients that we have. And again, we have offices in both the Tampa and Atlanta areas, although we do work with clients throughout the United States. So we may be geographically located here on the East Coast, but we have clients on the West Coast. We have clients, even some of the clients who live overseas as well. We try to set ourselves apart with our customer service experience. We dedicate every new client to one person in our office, one account manager who will answer any question they need regarding their account, assist them with transactions, and be that one point of contact rather than simply requiring our clients to call into an 800 number. We found that to be, get a lot of very good feedback on that. Just a little bit about what we do, and we'll get into today's topic. For anyone who's on the call who hasn't heard of a self-directed IRA, just want to touch on that just for a moment or two. Some people have not heard of what a self-directed IRA is because they have the retirement funds with a bank or with a brokerage firm who is offering them limited investment products. IRS regulations allow you to do a lot of different things inside your IRA, and that's what we do at Advanta. We will hold this very, very broad range of different investment options. So we are not a brokerage firm, so we don't hold mutual funds, stocks, and things of that nature, but we will hold a lot of different alternative assets. But the key thing to note, especially as we go through today's presentation, is that self-directed IRA is not a type of IRA per se that the IRS recognizes to an extent. The IRS looks at IRAs as either traditional IRAs or Roth IRAs or SEP IRAs. which all of those accounts can be self-directed. Self-directed refers to your ability, if you have money in one of these retirement accounts, to invest in an alternative asset that we'll touch on here just briefly before we get into the meat of today's presentation. So in general, why do people look for alternative assets inside a retirement account? For many, it's simply the cash that they have that they want to make an investment with is sitting in that IRA or sitting with a 401k. They would rather self-direct that account and purchase the investment through their IRA as opposed to taking a distribution from the IRA and be subject to taxes or penalties, or possibly just missing out on the investment altogether. So the IRA provides them with the capital, and we provide them with the service to keep that money tax protected in order to make that new investment that they came across. Other individuals enjoy the tax benefits of IRAs in general, which is that the income that is generated from an investment in an IRA, whether it's a mutual fund, whether it's a rental property down the street, accrues tax deferred or tax free back to the IRA itself. And quite a number of other people are just tired of the stock market, the ups and downs of the geopolitical events that happen not only in our own country but around the world that affect your retirement account. A lot of people makes them uncomfortable. I'd rather have my control. I can buy a property down the street in my neighborhood that I pass by every day, and I can take a look at that and know what's going on. Or I'm investing in a friend's company or a friend's business, and I know what they're doing, and I have much more control than you might have in the stock market. So as far as the types of assets that we see, any type of real estate, rentals, residential, commercial, rehabs and flips, condos, seeing a lot more multifamily and commercial syndications recently, which is a more passive investment for an IRA. So rather than buying your own rental property that you're going to have to hold and flip, you're investing into somebody else's larger project where you can just sit back as a limited partner. Similarly, we see a lot of paper assets, individuals who use their IRA to loan money from their IRA. They act as a bank, and their their borrowers, when they make their monthly mortgage payment or their monthly loan payment, simply pay back your IRA. So whatever interest rate you have established with your borrower is what is coming back into your IRA account. That's one other type. And then we see a lot of other alternatives as well. Private LLCs, people investing in farm animals, private partnerships, foreign currency exchange, precious metals, a lot of things you can do. The only two things you can't buy in an IRA are you can't buy life insurance and you cannot buy collectibles. Other than that, any investment type that you come across can be made inside an IRA. I will put with the caveat, so long as we can document that your IRA has ownership of that, which we've usually been able to find a way to do with just about any type of asset class. So again, self-directed IRA is not an account type the IRS recognizes per se. They just self-directed refers to your ability to invest in these truly alternative assets. Some brokerage firms will claim they have a self-directed IRA. What they are really doing is just allowing you to pick from the mutual funds or stocks that they have, but they're not opening up their accounts to these true alternative assets. So these assets can all be held inside a number of different IRAs, different types, different IRAs that have different contribution limits, different deadlines on when you establish them. And that's really what today's presentation is going to cover. We're not going to talk much more about self-direction, although if you have any questions, again, on what I've already covered here regarding self-directed IRAs or shortly what I'm going to get into, please make sure you type those into the question box on your screen. Before we jump in really to go into all IRAs, I thought it'd be a good idea to start maybe with the history of really IRAs and 401ks, kind of where they came from, why they got started. The traditional IRA, probably the most common type of IRA account that's there, were created back in 1974 under the ERISA Act, under Title II. And they originally were designed for two reasons. One, there were a number of individuals who did not work for a company that was offering them a pension plan. So they designed the traditional IRA to give individuals who were not covered under a pension plan their own tax advantaged way to save for their own retirement accounts. So traditional IRAs were originally created for those people to have a way to make their own contributions and control their own retirement if they didn't work for a company that was offering a pension. And also the people who did work for companies that had pensions, when they left those companies and they retired, or they just changed jobs and changed employers, it enabled the traditional IRA now enabled them to take that pension plan and move it and take it with them, and then invest as they chose, rather than simply leaving the money with their employer and just waiting for that benefit down the road. So the genesis behind pensions and IRAs in general as well is there are great tax benefits. The IRS gives us and Congress gives us tax benefits encouraging you to save within those accounts. The more money you have inside your IRA, inside your 401k, or even a Roth IRA, when you get to retirement age, that's more money for you to live off of. It's less, means you're going to be less dependent on other government and social services. So again, part of the genesis of creating the IRAs is helping and encouraging people to save for their own retirement account, and lessening the burden on government going forward. So traditional IRAs were created in 1974. In 1978, the Revenue Act of 1978 added the section, IRS Code Section 401k, that allowed employees to avoid taxation on the deferred compensation that they were making into retirement plans. That's when the 401k was actually created, was back in 1978. So up until that point, a lot of employer plans were pensions, where the employer would put money into the plan on behalf of the employee. When the employee retired down the road, the employer would hopefully have invested that money correctly to give them a defined benefit. The pension plan is a defined benefit plan. So when you retire, you will receive X number of dollars per month from the pension. The 401k kind of switched things up a little bit and put the onus more on the employees, and that it allowed the employers and the employees to defer compensation into the plan. So the employees could put their own money in, again, avoid taxation, and hopefully encouraging them to save more money inside that plan. And then the employees that were actually in charge of investing those monies, and then the company wasn't on the hook really for the pension plan at the end of the day. And also 1978, the SEP IRA was created under that same Revenue Act. We'll get into those accounts in a little bit as well. In 1986, something that's still in place today is Congress made some changes to the IRAs, and they started limiting the ability to deduct your contribution to a traditional IRA if you or possibly a spouse was covered under an employer's plan. So if you were working for a company that had a 401k, if you also contributed to a traditional IRA, you may not be able to take that tax deduction. Again, so there was tax advantage ways to, again, encouraging people to save for their retirement account, but they didn't necessarily want people double dipping if they were also covered by an employer's plan as well. So they took away that deduction for certain individuals in 1986. Again, that's still in place today, and we'll cover that in just a moment. 1996, the Simple IRA, or the Savings Incentive Match Plan for Employees, was created by the Small Business Job Protection Act. That's a special type of retirement account geared for small businesses that have less than 100 employees. 1997 was a very big year in the retirement plan industry, in that the Roth IRA, named for the senator from Delaware, was created, that allowed people who were not going to get a tax deduction for the contribution to a traditional IRA to actually contribute to a different type of an account where they didn't get a deduction up front, but that money would actually grow tax-free going forward. So the Roth IRA allows individuals to put money into that account, forego a deduction, but knowing that ultimately the money they're going to be receiving is coming back completely tax-free. Again, that started in 1997, was when the Roth IRA was created. 2001, the EGTERRA Act, Economic Growth and Tax Relief Reconciliation Act, increased contribution limits on the accounts. A lot of them are now subject to inflation. Each year they adjust every couple of years, or every year depending on the type of an account, for the amount you can contribute. And it added catch-up provisions as well. So people who are over a certain age, usually if you're over the age of 50, you have the ability to make a larger contribution into your particular retirement account. So the types of accounts, again, that can be self-directed, that we're going to cover today as well. Traditional and Roth IRAs, the SEP and Simple IRAs, and individual 401k plans for people who are small business owners. We're going to touch on the health savings account as well, and its contribution limits and deadlines. But keep in mind, if you're looking to self-direct and looking for alternative assets, any type of IRA would qualify. Any type of health savings account qualifies to buy alternative assets. And then also any former employer plan, an old 401k, an old 403b plan can also be rolled over into a traditional IRA and used to purchase a self-directed, type asset within the account. All right, so we're going to kind of just go through a number of these accounts. Don't spend a whole lot of time on it, but again, if you have questions as we go, please type those in. I want to highlight some of their, point out the highlights of each type of an account and go over the deadlines for contributions and also the limits that are involved. So for a traditional IRA, again, I mentioned this is the IRA that was created in 1974, most common type of an account. It's been around the longest. That anyone who has earned income, defined by IRS, earned income, W-2 wages, income that you're paying self-employment tax on possibly. If you have earned income, you are eligible to contribute to a traditional IRA. Now, that again, I mentioned back in 1986, they took away the full deductions to people based on your income and if you're involved in a 401k or an employer plan through your job. So, but anyone can have a traditional IRA. Anyone can make a contribution as long as you have earned income. The benefits of the traditional IRA, you're going to get a tax deduction in many cases, lowering your tax bill. You get the benefit of tax deferred growth. Again, for those of you who are not familiar with what the benefits of tax deferred growth do, you're investing and reinvesting over a period of years. If you do not have to pay tax each time you buy or sell an asset and can continue to defer the taxes, you're going to have more and more money compounding over time, enabling you to buy more and more assets and grow your account more quickly than if you were paying tax each step of the way. So the genesis, the idea behind creating IRAs from the government's perspective, encouraging people to save for their retirement by giving them these great tax benefits in order to do so. Now, any former 401k or any former employer's plan, for that matter, can be rolled over directly to a traditional IRA with no tax consequence. Just moves from that pre-tax 401k into the pre-tax traditional IRA. Now, for anyone looking to make a contribution for a traditional IRA, the deadline is April 15th of the year following the particular tax year. So we're in 2019 now, the tax year running January through December of 2019. Individuals have until April 15th of 2020 to actually make this contribution to the traditional IRA. It does not have to be made in the particular calendar year. So you have until April 15th. That date, April 15th, can change year to year. If April 15th falls on a Saturday or Sunday or on a holiday, for some reason, sometimes it might be April 16th, April 17th, that gets extended out, but that's the general date. And currently, the contribution limits, the most you could contribute to a traditional IRA in a given year is $6,000. If you're over age 50, I mentioned the catch-up contributions are available. For some accounts, you can put an extra $1,000 in. It's for a total of $7,000 contribution limit for a traditional IRA account. Now, the deductibility, again, those that changed back in the law in 1986 said that if the individual participant or if they were married and it was a spouse are covered under a 401k or another type of employer's plan, the ability to deduct your contribution to the traditional IRA is limited by your annual income. So if you're single, once you reach $74,000 of adjusted gross income and you're covered by an employer's plan, you no longer get the deduction for contributing to the traditional IRA. Again, if you can see the different numbers there, if you're married and you're the participant, the number is $121,000 a year, or I'm sorry, $123,000. There's a little typo there. And if you're the spouse, if you're contributing to your traditional IRA and your spouse is involved in a 401k, the adjusted gross income between you both has to be less than $200,000 or $203,000 to get that deduction. Now, keep in mind, you don't automatically get the deduction, but also you can still make the contribution. It may not always be wise from a tax standpoint, but if you still wanted to put money in, you can put money in without the deduction into your traditional IRA. You will be able to pull those monies out down the line tax-free from the account. So the IRS does have you file a certain form where you keep track of all of the different monies that you've put in that have not been deductible over the years, and you will be able to take those monies out on retirement without paying tax, but the growth is still tax deferred. Probably the second most common account we deal with at Advana and different retirement out there is the Roth IRA. Even though they came into being in 1997, they've been very popular among advisors and tax advisors, and certainly investors as well. Because with a Roth IRA, the benefit it gives you is that you do not get a deduction on your initial contribution, but the money that goes into your Roth IRA, because you paid tax on the initial funds going in, you will not pay tax on the money when you pull it out. So with a traditional IRA, you get to retirement age and you take a distribution. Whatever you pull out is included in your income at that time. So you do still get the benefits of tax deferral with a traditional IRA, but you will face the tax man at one point when you pull money out in retirement. The Roth IRA eliminates that. So you're able to put contributions in, not take a deduction up front. And when you reach retirement age, you can pull all the money out of your Roth IRA completely tax-free. The requirements to take a tax-free distribution are that you be over 59 and a half and you have had a Roth IRA for at least 5 years. So if you've already started a Roth IRA, even with a small amount, you've already started your 5-year clock, moving your money from one account to another, whether it's from Fidelity to Advana or Advana to Schwab, your 5-year clock already started with your first contribution. So anyone who has earned income is eligible to contribute, but the Roth IRA does have income limitations that make you ineligible to actually contribute directly to the Roth. Now, the contribution deadline for the Roth is the same as the traditional, April 15th of the year after the tax year, and the contribution limit is the same as well. That's 6,000 or 7,000 if you're over the age of 50. Now, contributions to a Roth and a traditional, you can total between the two only make a $6,000 or $7,000 contribution. You cannot contribute 6,000 to a traditional and also contribute 6,000 to the Roth. So please keep that in mind when doing your planning. So again, there's certain income limitations. Again, you cannot. Let me see. One moment. Let me jump a slide or two. Make sure I have the right slide here. Oh, I might have inadvertently omitted that slide today. But as far as your income limitation with the Roth IRA, if you're over a certain limit, you cannot contribute to the Roth IRA. I know for a single individual, the number's around 125,000 or so. If your adjusted gross income exceeds that amount, you cannot contribute to the Roth IRA. So the traditional IRA, the limits we went over were simply you don't get a deduction. With the Roth IRA, you simply cannot make the contribution at all. And again, for a single individual, it's around 120,000 or so. If you're married, filing jointly, it's that $203,000 number that we saw on a prior slide as well, that you cannot then contribute to the Roth IRA. Now, we covered in a previous webinar a few weeks ago the Roth conversion, so just kind of highlight that again a little bit. So people who make, say, a non-deductible contribution to their traditional IRA, so they didn't get a deduction, but they went ahead and put the money in anyway, may want to move and transfer that money into a Roth and do what they call as a Roth conversion. And this is another tax planning strategy that is especially important this time of year, because we're going to go over why in just a moment. But you can move money from a regular IRA account that's taxable into a Roth as long as you're willing to pay the taxes now, basically take the tax hit now and have that money growing tax-free within the Roth IRA. The one thing that's neat about the conversion that, again, was part of that 2001 legislation was that everyone is eligible to convert. So you may not be eligible to contribute to a Roth because your income is too high, but if you have money in a traditional IRA or a SEP IRA, you are eligible to actually make that conversion. So it does not matter how much you make. Again, the benefits immediately are that your money is now growing tax-free inside the Roth IRA. If you don't qualify to make a contribution to a Roth IRA, again, you can always make that contribution to the traditional and then simply do a quick conversion into the Roth. They call that a backdoor Roth contribution, basically. You put the money first in a traditional and then use a conversion to move it over. Conversions can be partial or full, so you don't have to do your entire account. You can only kind of do what you, I guess, could stomach for the year. And this is why we say this is a great planning opportunity, especially at the end of the year, to talk with a tax advisor and find out, what does my tax situation look like does a conversion make sense for me in order to do that? Now, the reporting that's involved when you convert to a traditional, say to a Roth, the conversions reported on a 1099-R that you get, that you then again will include when you file your taxes to pay the taxes on that income. And then the Roth also, we file a 5498 form that shows what was converted as well. Now, the key thing about doing Roth conversions, I mentioned why it's so important to talk to a tax advisor now, is that in order to do a conversion, they must be done by December 31st of the tax year, not April 15th. So again, a lot of people associate April 15th as my deadline for traditional and Roth contributions because that's exactly what it is. But they forget or not realize that the conversion actually has to be done by December 31st. So again, prime reason why and a prime opportunity to talk to your tax advisor prior to the end of the year. If you have, paper losses, depreciation on some investment, some real estate investments that you have that's going to limit your taxes for a year, that's a great opportunity to maybe take advantage of those losses to offset the income from a conversion and just move the money from a traditional to a Roth, still with no tax consequence, and then have that money growing tax free. So make sure you kind of look at that before the end of the year because that is one of the deadlines. Now, one thing that came in 2017, kind of an unwelcome change to the Roth conversions, is that you can no longer undo a Roth conversion. Now, prior to that Tax Cuts and Jobs Act, if you did a conversion from a traditional to a Roth, and then got and sat down the next year and decided, maybe I bit off a little more than I could chew, you could actually undo part of that as a recharacterization, and that is no longer available. So once you sign the dotted line to make that conversion, it's done. The only exception is that you can recharacterize contributions. So if you were to make a contribution to a Roth IRA and then you weren't actually eligible to make that Roth contribution, you are permitted to recharacterize it back to a traditional IRA, but you cannot undo a conversion. Had a couple of good questions pop in here. Let me get these answered. So can you only convert a traditional IRA to Roth in the same year, or can it be done in the future as well? And the answer is that you could do this multiple times. So I've had clients who say had $100,000 worth of assets in their traditional IRA, and they've converted, $25,000 of that account over a 4-year period of time to ultimately get that money into a Roth and just spread out that tax bill over a couple of years. So you have the flexibility. Again, it's either partial or full, but again, you just can't actually undo the conversion, which again, another question is yes, you cannot undo a conversion. One question, can you convert for somebody who's over the age of 70 and a half? Yes, anyone can do a conversion to a Roth at any point. It does not matter your age, and again, it does not matter your income level as well. So you can do that. Again, the only thing is you can't undo it. So please make sure, again, if you're thinking about doing a conversion, have that conversation with your tax advisor to make sure it's going to work out for you. All right, moving on. Talking now a little bit, spend a few minutes on the different types of employer plans that we offer at Advana that we see. The first is a SEP IRA. Typically, sole proprietors, independent contractors, self-employed individuals, that's what these plans are designed for. So the traditional IRA and the Roth IRA only give you that $6,000 a year to contribute. And you may have a 401k at work though as well if you're just an employee to help save for your retirement. But sole proprietors and independent contractors, the SEP IRA was designed to give them the ability to put away more money for their own. And they work just like a traditional IRA. You get tax deductions for the contributions, you get the tax deferred growth as well within the account, and ultimately it will be taxable to you in retirement. So they have much higher contribution limits that we'll see in just a moment, but they're lower and cheaper to administer than a 401k plan. So if you own your own business, SEP IRA is a cheaper way to go as far as administration costs. However, if you have employees in your business, you may have to include certain employees inside that SEP IRA. So sometimes I would say probably the majority of the SEP IRAs that we see at Advana are for sole proprietors, people who have employees. We'll see in a minute why you don't necessarily want to have a SEP for those. So the contribution deadline For a SEP, you have actually until your business tax filing deadline plus extensions. So as late as October 15th of the year after your tax year, you can still establish a SEP and make that contribution. So for 2019, if you want to make a SEP contribution for 2019, you actually have until October 15th of 2020 to make that SEP contribution. Now, the contribution limits for the SEP, again, why they're so attractive to sole proprietors and individuals, is you can contribute a percentage of your overall compensation. You cannot exceed 25% of your compensation. And your maximum contribution to the SEP can actually be $56,000 a year here in 2019. And that number usually increases about $1,000 a year each year going forward. So again, much larger contribution limit for the SEP IRA than a regular IRA. And again, for people who own their own businesses, who are sole proprietors, much better way and more effective way to make contributions. The question says, came up with the SEP, is the contribution limit based off of gross income or net income for sole proprietors? I am not 100% sure that. I don't want to answer that question, give you bad advice. That is a great question for a tax advisor or a CPA on your sole proprietor to figure out. Generally speaking, it's the amount that you're paying your self-employment taxes on, and it's part of your actual earned income. So again, sorry I can't fully answer that question, but that's a great question for a tax advisor if you have one. Say, hey, here's my income from last year, here's my tax return, how much am I eligible to contribute for a SEP IRA? And I'd encourage you as well, maybe give me a call afterwards of the presentation. I'll try to look into that a little bit for you as well. Going back just quickly, another question popped up when I get it addressed. Somebody asked, how do you calculate how much you can convert? If you're moving money from a traditional, maybe even a SEP to a Roth IRA, there are calculators online that will help you figure out what you might be looking in taxes. Does it make sense based on future growth? But that's, again, a question for a tax advisor who's going to know what tax bracket you fall in or are going to fall in, or if you have other losses, how they're going to affect the amount that you're converting. All right, so getting back to the SEP again, for sole proprietors, a much larger contribution limit. SEP IRAs also can be combined with other SEPs, traditional IRAs and former 401k plans. So if you have a traditional IRA at Fidelity and a SEP IRA at Schwab, you can move those monies between the two with no tax consequence and no issues as well. So again, we've seen a lot of people combine those types of accounts in order to make that happen. You certainly can also convert a SEP to a Roth IRA account. And this is kind of an interesting strategy. Had someone do this years ago, have money, were able to put in $25,000 a year as a SEP contribution and got their tax deduction for that. Then they immediately converted it, all of it, to a Roth IRA, which then they had to include that back in their income. So it was a net of zero to them really from a tax perspective, but they ended up with $25,000 Roth contribution by using the SEP IRA and then also immediately converting it to the Roth. Again, the one reason we probably see most SEP IRAs with people who own their own businesses without employees is because if you do have employees inside your SEP who qualify, if you contribute 20% or 25% of your compensation for yourself, you also have to do it for any employees who are over the age of 21 and they have worked for you at least 3 of the last 5 years. So if they meet those two considerations, that they are over 21 and they've worked for you at least 3 of the last 5 business years, whatever percentage you contribute for yourself, you have to contribute the same percentage of their compensation for them as well. And again, that's a little bit more onerous than you might find with a 401k or the simple IRA that we're going to talk about here in just a moment. So again, that's why we see SEP IRAs for a lot of times for sole proprietors. The simple IRA, I'm being honest with us, we don't see a lot of these at Advanta, but they certainly can fit the right situations. For people, again, who are sole proprietors, again, not as many. A lot of those will do a SEP IRA if they don't have any employees. But if you are somebody who does have employees and you have less than 100, you can qualify to open up a simple IRA account for your business. And a simple IRA is a lot like a 401k plan. It just is a lower cost to administer. But you do have to include certain employees. We'll go over that here in just a moment as well. So for a Simple IRA, it's tax deferred just like the traditional IRA, and it has both employee and employer contributions, like again, like a 401k. It's just cheaper to administer. So if you have a simple IRA for your business, you are able to have your employees make contributions and the employer kicks in money as well, just like with a 401k. Now, the contribution deadlines for simple IRAs, you have to have the employee has to, all those salary deferrals have to be made by January 30th of the following tax year. So again, for 2019, if you have a simple already established, the employee's portion needs to be inside the account by January 30th. And then the employer's kind of match needs to be done by October 15th. So again, your tax filing deadline plus extension. So you have until October 15th of 2020. Now with a simple IRA, the employee can defer up to $13,000 of their salary into the plan. If they're over 50, they get a $3,000 catch-up. So they could put in up to $16,000 of their own salary into the plan. And then the employer, and if it's you, the business owner, this is you, can contribute between 1% and 3% of their employees' compensation into the simple IRA as well. And that's the employer contribution can be done in one of two ways. And we'll go through that here in just a moment. So another key deadline for, we're talking about the simple IRA, is that the simple IRA, if it's not yet in existence, it must be established prior to October 1st of the tax year that you're making the contributions. This is kind of one exception to the other types of accounts that the deadlines are a little bit later. If you wanted to create a new simple IRA for 2019, you've already missed that deadline. It was a few weeks ago on October 1st to start that new simple. Now, if you already have one in existence, the contribution deadlines I just covered still apply. But that's, again, something every now and then we'll have someone looking to do a simple after that deadline. It simply is too late. So if you're setting up a simple, though, for your business, again, the employee can contribute their salary, and you as the employer can make a matching contribution in one of two ways. You could elect to offer a non-elective contribution, which means that for any employee who does not defer their salary, or if they do defer their salary, you as the employer are going to contribute 2% of their compensation regardless. So again, it's a non-elective contribution. The employee does not have to elect to participate. You just agree that you're going to give everybody 2%. Or you can set up the contribution to be made as the employer as an elective contribution, where in order to have the employer, you as the employer, put money in for your employees, they do have to defer their salary, and you typically would match up to 3% of their compensation. So again, I've had employers that we've set these up with. Some of them have done elective contributions because they didn't feel that their employees would actually defer their salary. So in that case, they wouldn't be on the hook for making contributions. If you were running a business though where every employee you knew would participate and you were limiting your matches, you may do the non-elective route and simply only have to do 2%. Now, interesting with simple IRAs is you actually cannot combine them with other IRAs until the simple has been established for at least 2 years. It's the one kind of account that's really out there on its own for this. I'm not really sure the reason behind it, but after 2 years, you could transfer a simple IRA into a traditional IRA or a SEP IRA after that 2-year period. However, you cannot move money from a traditional or a SEP into a simple at any point. So regardless of the time frame, you can never move other non-simple funds into the simple, but after 2 years, you may be able to move some of the simple IRA funds out to other types of accounts. The employee eligibility, again, for simple IRA, you can restrict the eligibility to employees who are over 21 and have worked for you at least 2 years in order to even be eligible for the simple IRA. Next employer plan is solo 401k. The plans we offer at Advantage, sometimes they're called QRPs. Other people call them uni-Ks, individual Ks. They're all the same thing. It's a solo 401k. It offers you the ability, if you're self-employed, if you own your own business and you don't have any common law employees, to set up a 401k just for yourself and your own business. And as we'll see in a minute, the contribution limits are much larger. And you can reach the higher limits more quickly with this type of plan. but they are especially for people who do not have any W-2 employees. The benefits, the solo 401k, again, you can do both tax deferred contributions or even after tax Roth contributions to the plan. You can borrow from a 401k. Those of you who might be in a 401k now know that you have the ability to take a loan. Same thing applies to the solo K. There's no UDFI or UBIT tax on leveraged income. That's, again, if you're not sure what that is, just don't worry about it. But it's a benefit for people who are buying assets that have mortgages or have other leverage involved. Now, the deadlines for a solo 401k, as far as the contribution goes, generally speaking, the employee who's deferring their salary, again, the solo K is a lot like the simple. There's an employee salary deferral, and then there's an employer's matching contribution. The employee's salary deferral should be made by January 15th or so. The IRS there's no hard and fast deadline. They just say it should be made within a reasonable time since the employee actually took the salary. So if you issued yourself a paycheck on December 31st, you should then at least make that contribution within a few weeks after that. That being said, you as a trustee of the plan may decide to make it later than that. It's really going to be up to you to an extent, but that's what the IRS guidelines are. The employee's salary deferral should be contributed into the plan within a reasonable time after the salary was taken. The employer's matching contribution, though, again, as we've seen with the SEP and the simple, you have till your tax filing deadline plus extension. So not until October 15th of the year after. So for 2019, if you establish a solo K, the employee's salary deferral really should be made in January, and the employer's match you might have until October 15th of 2020. Now, the contribution limits, the employee's salary deferral. So again, this is the Roth, the after-tax contributions, or even a pre-tax contribution. The employee salary deferral is limited to $19,000 a year, or $25,000 if you're over the age of 50. So you, as the employee of your own business, can contribute up to $19,000 or possibly $25,000 of your salary, and that salary again can be that salary deferral can be designated as a Roth contribution. And again, those deadlines for those are roughly, again, in January is when you really should be making those contributions. The employer's contribution, the match, you can elect as the employer to match up to 25% of your compensation to an additional maximum of $37,000. So the total combined contribution of both the salary deferral and your employer's match, if you're under 50, is the same $56,000 that you have with the SEP IRA. Now, if you're over 50, it's actually $62,000 total that you can contribute to a solo 401k. So the contribution limits for a solo K, again, much higher than you would find in conventional IRA. We did have someone that posted, if anyone's looking for the answer on the question about the SEP IRA, someone did post it in the question box. I'll leave that up. Somebody asked, can the slides from the webinar be emailed? Yes, absolutely. We can get these slides sent out to everyone as well. Someone says, what is the solo 401k deadline contribution for the after tax, the Roth contributions? Again, in general, the IRS said the Roth contribution of salary deferral should be made within a reasonable time that the salary is taken. And if you're taking that last paycheck on December 31st, probably should make those contributions in January. So the question of if a solo 401k is for a company with no W-2 employees, how can an employee contribute a salary deferral of 19 or 25K? Good question, and may apologize for not explaining that. If I own my own business, I kind of wear two hats for that business. I am both the employee working for the company, and I am also the business owner or the employer. So if I have my own company, in order to have a solo K and make contributions, I would need to pay myself a salary in order to make that contribution. And as the employer, I can also do a profit sharing match on top of that. So for solo Ks who don't have W-2 employees, you still do have an employee that is the business owner. And that's what the solo K is utilized for. You would have to take, as the business owner and an employee, a salary to make that deferral. I hope that was clear. Question, solo K after tax contributions are separate from elective deferral. What would be the contribution deadline for them? I believe those would be possibly the after tax. It's not the salary deferral. Um, would be, I believe, the contribution deadline of October 15th. But again, that's something I'd have to double check for you afterwards. So getting back to the presentation, so the solo K, again, the benefit that they offer is there's a larger contribution limits if you own your own business, if you don't have employees who qualify, and you also have the ability, again, to take loans, and it's a more streamlined approach than having a full-blown 401k. It's not as expensive to administer. However, again, with the solo K, similar to the simple IRA, we don't have until next year to look back and say, hey, I should have established a solo 401k plan. The solo K must be established by December 31st of that particular tax year. So if you want to make a contribution for 2019, the solo K needs to be established by December 31st of that particular tax year. So you can make the contributions into January into next year, but the plan itself needs to be established by December 31st. Now, traditional and SEP IRAs and even old 401ks, they can be combined or rolled over into a solo plan as long as the plan documents allow for it. And our plan at Advanta does allow for rollovers from IRAs and old 401ks. However, the Roth IRA cannot be rolled over into a 401k, even if you have designated the 401k to have the Roth salary deferral feature. So again, that's kind of a key thing to keep in mind. Individuals, you can make that salary deferral as a Roth contribution and make it kind of what they call a Roth 401k, but you cannot roll over a Roth IRA into the 401k. And I asked this question years ago of a consulting firm we use on why not, and the answer I got was simply that when they wrote the rules, they messed up in not allowing for it. So it hasn't been something that's been fixed, so just keep that in mind. Now, a solo 401k, again, can be used by business owners as long as they do not have employees who meet the following requirements. If they're over the age of 21, and if they work more than 1,000 hours a year. At that point, if you have someone who's working for you as a W-2 employee who's over 21, and once they work 1,001 hours a year, they must now be included under a 401k plan. And at that point, the solo plan, the safe harbor plan, would need to be amended, and you'd have to get a third-party administrator involved to actually do the testing and doing the reporting on an annual basis. So your cost is going to go up quite a bit going from the solo K to that type of 401k account. The reporting requirements as well for a solo 401k with IRAs and HSA accounts that we're touching on today. At Advanta, we take care of that annual reporting. But when you do a solo 401k plan, you as the business owner are acting as trustee and likely the administrator of that actual plan. And you would need to make sure that you're separately reporting your contributions to the IRS on an annual basis, as well as filing an annual return for that 401k plan. Now, the annual return for a 401k is called a 5500 EZ, is for the solo 401k, but it actually does not have to be filed until your plan assets exceed $250,000. So if you're just getting started with your solo K, you're not going to have to file that 5500 EZ until your plan assets exceed that $250,000 or the year the plan is terminated. So keep that in mind. Even if you set up a solo K for 2 years and you never reach that $250,000 threshold, when you terminate the plan, the IRS does want you to file that final 5500 EZ to them, letting them know the plan has been terminated. But again, the solo K, that's not something Advanta reports on with the contributions. We can certainly keep track of them and give you all the information, but it is up to you to make sure to make those proper contributions. Just a quick illustration, the differences between the simple, the SEP, and the solo K for people who are self-employed. Anyone who, say 2019, if you had $100,000 of income and you're under the age of 50, you can see the simple IRA, you'd be able to defer $13,000 of salary and then doing a $3,000 employer match into the plan. With a SEP IRA, you could do up to that 25% of the $100,000 salary, roughly, of $25,000. But where the solo K really gives you the huge benefit, as you can see, is you can defer the first $19,000 of salary into your solo K. And then the employer's match on top of that, you get the bigger bang for the buck with the solo K and the income that you have. So you get just a much larger contribution amount with the solo K. Again, along with that comes different reporting requirements and other things you need to do as a trustee of the plan. But if you didn't, you're looking the way to best maximize the solo K can be the way to go. Now, the last type of an account I'm going to cover with the contribution limits and deadlines, and we'll go over a few other things here as we wrap up. The HSA, health savings account. People who have high deductible healthcare plans, the HSA gives you a tax advantaged way to not only save, but then also pay for any potential health expenses. So the benefits of an HSA are that when you make a contribution to the account, you get a tax deduction. And when you take money out of an HSA to pay for a qualified health expense, the money actually comes out to you tax-free. So you get the benefits of both the traditional and the Roth IRA account all in one account for the HSA. So you get the deduction for the contribution, you get the tax-free distributions for qualified health expenses, and HSAs are portable as well. So even if you switch employers, even if over time you quit your high deductible healthcare plan, any money left in an HSA can still be used on a tax-free basis. The deadline for contributing to an HSA is the same as the traditional in the Roth. It's April 15th of the next tax year. And the contribution limits, if the HSA is for an individual, that's $3,500 a year that you can contribute. If it's a family HSA plan, the maximum contribution is $7,000 in a given year. And if you're over the age of 50, you get that $1,000 catch-up contribution as well. The question just popped up going back to the 401ks. Does the employer contribution limit of 25% of the compensation, is it in addition to the max employee contribution of 19 or 25K? The answer is yes. So the solo 401k is the contributions are both the maximum of your employee, as an employee, $19,000 for instance, and then you get the additional employer match of 25%. So the max contributions are 56 and 62,000 for a solo K. So to answer that question, again, keep those questions coming as we go through the presentation. Getting back to the HSA, again, the contribution deadline, April 15th, contribution limits depend on whether it's an individual or family HSA account. A little bit more on HSAs. An HSA does need to be established by December 1st for the year the contribution is being made. So for 2019, the HSA would have to be opened by December 1st of this particular year. So it's called the first day of the last month rule. If you're going to contribute for an HSA, you have to have that account established by December 1st of that particular tax year. So again, like the simple and like the solo K, you need to have the actual plan established in that current tax year. The contribution can be made though up until April 15th. Again, the distributions from HSAs come out tax-free as long as it's for a qualified medical expense, and the definition of what a qualified medical expense is can be found in IRS publication 502. And it has to also be expenses that are incurred after the HSA is established. So if you just underwent a medical procedure and said, wow, I wish I'd done that inside an HSA instead, you can't set up the HSA and go back and pay for something that's already happened in the past. However, one neat feature of HSAs, the tax-free distributions can be made at any point after the expense was incurred. So even if it's years later, you have some procedures, you have some medical bills that come up this year and you just pay them personally, but you have an HSA established, you don't have to have the HSA pay as you go. You could pay personally and sometime down the line, still take a qualified distribution tax-free for those expenses that were incurred. To be eligible for an HSA, you have to have a high deductible healthcare plan, and usually those are where you don't have any copays for office visits or prescriptions until the deductible is met. Usually it's best to simply check with your insurance company for eligible plans. Just call them up and say, how can I get an high deductible healthcare plan, or is my plan eligible? You also cannot have any other health coverage except you can have vision, dental, or other long-term care. You can't be enrolled in Medicare, and you cannot be claimed as someone else's dependent. So those are the 4 requirements to have an HSA and to make those particular contributions. So here's just a quick recap of the contribution limits for the different types of account. I didn't touch on the ESA today. The upper limit is $2,000 a year per child. We just don't see a lot of those at Advana, but certainly something you can look into. So again, I'm sorry, there's a type of the HSA is actually $3,500. again for an individual, and 7,000 for the family. So those are contribution limits for 2019. Those will change here. So I check the news, check online within a few weeks. Usually, roughly in November or December, the IRS will issue what the contribution limits will be for 2020. Again, here's the recap of the actual deadlines, as well the different dates that are important in a given year. So on January 1st, you can certainly start making contributions to any account. Once the new tax year is in place, you can start making a traditional Roth SEP contribution to that account, which is important. We'll see just a slide in just a moment. But again, you can see the other deadlines. Again, the employee contribution to a 401k should be made roughly by the middle of January. The employee contributions for simples by the end of that month as well. Again, April 15th is a kind of popular deadline, again, for traditional Roths and HSA contributions. And October 15th as well is the last date for those employer contributions as well. For December 31st, as we're coming up on the end of the year, again, the December 31st is the deadline to complete a Roth conversion. It is the deadline to establish a solo K. And for anyone who's over 70 and a half and has a required minimum distribution that you must take. So with regular taxable IRAs, you're required to distribute funds after age 70 and a half. You must take that RMD by December 31st. If you're not sure if you have to take one or not, call up your IRA provider and ask them, because if you miss your December 31st deadline in taking your required distribution from the account, the IRS will assess a penalty of 50% of the amount you should have distributed. So that means if you had a $20,000 required distribution that you were supposed to take and you don't take it by December 31st, the IRS will assess a penalty of $10,000 against you for not taking that distribution on time. So if you're not sure what that amount is, or if you've taken it yet this year, please call your IRA provider. And again, it's required for anyone who's over the age of 70 and a half with your taxable IRAs. Now, Roth IRAs do not have an RMD requirement. One thing that's kind of neat as you get to between a certain type of year, you can double up your contributions to an account. So between January 1st and April 15th, every year, you can basically double the contributions to your IRA. If you had not made a contribution for the prior year and you were looking to start a new IRA, you can make contributions both for that prior year and the current year into that same IRA account. It's going to give you obviously more money towards investing. And you think, especially if you were to double up, say, a SEP IRA, you all of a sudden have over $100,000 worth of funds to make investments. Now, when you make that contribution on January 1st, like say for a current year contribution, you don't have to have all of the earned income, obviously, on January 1st to make that full contribution, but you do have to have it by the end of the year. So if you'll say you made a full SEP contribution of $56,000 on January 1st for that tax year, you can make the contribution, but if you don't end up with enough income to support that contribution by the end of the year, you will have to withdraw some of that money out of that particular plan. The annual tax reporting, just to kind of finish up the slides here, just with any IRA, HSA, or 401k, you do have to file a 1099 each year to report any distributions to the IRS. The 1099s are filed or need to be filed by January 31st. So at Advana, again, we do that reporting for IRAs and HSAs. If you have a 401k, you need to report that for yourself on a solo basis. So the Form 1099 is filed to the IRS by January 31st for the previous tax year, letting them know of any distributions that came out of those accounts. A Form 5498 is filed for any IRA or HSA, and that's something, again, Advana, as the administrator of those accounts, we will file that 5498 form to report a few things: the annual contributions that are made to the account, any rollover contributions if you move money, from an old 401k to an IRA that's coming in, and also conversions. We report those on the Form 5498. And we also report the annual fair market value of any IRA or HSA. It's also something the administrator of your IRA or HSA has to do, is report the annual fair market value of those accounts to the IRS. Now, we do reach out to our clients and ask them to supply us with an updated value by March 15th. Since we deal in alternative assets, there is no ready market to go to get that valuation. Key thing to note, especially if you're a tax advisor yourself or you get asked by your tax advisor, 5498 forms are not filed with the IRS until May 31st for that previous tax year. So you may get, if you were to roll money over from a 401k plan into an IRA, you're going to get a 1099 on January 31st that you're supposed to report on your tax return. And since you rolled that money to an IRA, ultimately it's not going to be taxable to you. But there is no corresponding form that you have to file with the IRS when you do a rollover from a 401k plan. So the 5498 though will tell the IRS that yes, indeed, that money was rolled over, but it's not sent until May 31st. So after you've already filed your taxes, if you file by April 15th, you will simply just tell them, hey, I did a rollover, and my administrator is going to send that notification to you at a later date. If you're a solo 401k, again, you have to file the form 5500 or 5500 EZ once your assets are over $250,000 or the plan is terminated. And on that document, you do report the annual valuation, contributions, number of participants, etc. The deadline to file the 5500 is July 31st for that previous tax year. Moving money between accounts is easy. It's either doing a transfer from IRA to IRA or HSA to HSA. There's no tax reporting that's generated. If you are rolling money over from a 401k or an employer plan to an IRA, again, it will generate a 1099 from your resigning administrator, but the IRA custodian will file the 5498 to offset that. Again, it's also a tax-free movement of money. And then if you do, there's also another way to take money out as an indirect rollover, is where you personally take possession of money with an IRA. You can roll it over within 60 days that you receive it to another IRA to avoid taxation. However, keep in mind that will trigger different tax reporting, either on a 1099 and then again also the 5498. Again, it's important to remember, if you have a 1099 event, either because you do a direct rollover from a 401k or you do an indirect rollover from an IRA where you take possession, you'll get that 1099 by January 31st and have to file your tax return, but that 5498 doesn't get filed until May 31st. Just know that your custodian is going to file that form on your behalf. At this point, I'm going to go through the other questions we have. We had a question came a little bit late. The slides and the recording is available for distribution. Yes, we can certainly send these out to other individuals. The recording, anyone who signed up, even if you're listening to this live, we send the recording out as well. It should be available probably on Monday or Tuesday of next week. You'll get that. We can certainly send out the slides as well. My contact information is here on this last slide. If you have other questions, again, I apologize. Some of the questions I couldn't answer just because it's not my full background to give all the different tax information, but it certainly can, again, point you to a tax advisor to help you answer some of those questions. I hope it's been informative. But if you have any other questions that pop up, either that you had during the seminar that weren't answered, or something you want to ask later that comes up, please don't hesitate to reach out to me or reach out to our company. We're happy to help out as much as possible in answering questions. Again, we specialize in self-directed assets in the alternative space, but we certainly have the knowledge on the general IRAs information as well. So at this time, I'm going to conclude the webinar. I thank everybody for participating. And if you have any questions, please reach out to us, and we look forward to hearing from you.